All right, it's 12 o'clock. I'm going to call this meeting of the Audit Committee to order, and I'm sure that everyone's going to take their seats. We're going to get underway. Thank you, thank you. The city manager and I were just over at the change of command ceremony. The new chief of police, Steve Williams, was signed in, and I'm sure all the excitement about that is just carried over into the Audit Committee meeting. So we have a lot of items on the agenda, of course, for members of the public who can't see. This is the financial statements binder, which is the first item on the agenda. I want to start with that, and perhaps we can just lead off on that one. We're going to have time for lots of questions. Colleagues, I will ask, because the binder is quite significant, that when we're talking about a particular issue, start with the page reference so everyone knows where we are and what we're talking about, and then we can ask questions, because it's sometimes hard to find the reference point. So start with the reference point if you could. Any opening comments from our staff about the financial report?
Thank you through the chair. So Mr. Collins is going to walk you through a presentation, but I think just to start off is what we have before you today is a whole lot of work, and I know it might seem really easy to produce this really quickly, but because of all the consolidation that has to happen with our boards and commissions and bring everything together, and we've been down staff this year, so we've kind of had a bit of a perfect storm all at once. So a huge thank you to all of my finance staff, and particularly the core finance team that has worked really, really hard in spite of the challenges to get this before you today. So I think what it does is it truly shows that the City of London's had some very great success in 2018. So I think that is huge, and thank you again to KPMG and their whole audit team in terms of all the work that they've worked collaboratively with us to give us time to keep things going. So it's a bit of an iterative process sometimes. So with that, I'm going to turn it over to Mr. Collins, who's going to give you a really good overview of the entire package.
Thank you. And just before you start, Mr. Collins, I did skip a section, and Mr. Schultz was kind enough to point it out. I'm just going to read the statement. The City of London is committed to making every effort to provide alternate formats and communication supports for council, standing, or advisory committee meetings and information upon request. To make a request for any city service, please contact accessibility@london.ca or 519-661-2489, extension 2425. I will just add, you could also call 311 and punch in that same extension.
Thank you to the chair and committee. Just want to go over City of London's 2018 Consolidated Financial Report. Building on what the City Treasurer led off with, we should also acknowledge the work that was done by a lot of our city services in contributing to the information that was presented in the financial report, as well as the work that was done by our outside city boards and commissions in their finance team as they worked on the deadlines in order to get their information into KPMG, our external auditors, so that they can perform their duties and coordinate with city finance staff in order to ensure that there was a seamless consolidation. Moving on to the composition of the 467-page document that you see before you, I just want to walk through committee some key sections that you may want to be aware of if you're not already. The first section and the first tab really highlights some of the key financial policies that govern the city's finances. And you'll notice it talking about our capital financing policy, our tax policy, our investment policy, as well as there's a section talking about our budget process, which stems from our multi-year budget policy that council has approved as well. Flowing from that, we provided a brief macroeconomic overview, starting with the nation, cascading down through some of the provincial trends, and then into the local level, highlighting some of the key economic indicators that we pick up on finance related to building permit activity, as well as assessment growth. Following from that, we provide a quick synopsis of our 2018 financial results, including trends for items such as the proportion of revenue that the city takes in. Of note, in 2018, you'll see a slight decrease in the proportion of municipal taxation revenue that the city's taken in, which has been offset by some government grant payments and some other revenue coming from contributed assets from developers. Also, we have some trends related to reserves and reserve funds. When we posted the financial report onto the city's website. We included 2 pages related to trends in reserves and reserve funds. The print job that was distributed to Audit Committee and to Council missed those last 2 pages in that section, but they are included for you right now. Those indicate some interesting trends related to debt and to our reserve and reserve fund positions. Fourth item that we have tabbed outlined is a 5-year review that provides some general statistics that really provides a broad overview of some key financial items that the community and council would find interesting related to municipal taxation, the percentage of tax levies in arrears, our debt, our assessment growth, the amount of debt we're taking on, as well as our accumulated surplus. This seems to be a common practice in other municipalities, and it's been well received at past audit committees, so we continue with that practice. The big component that makes up the 467-page document before you is the consolidated financial report. Some people ask, why are we doing this? Why do we take 6 months in a year to pull this all together? And the big reason for that is under Section 294.1 under the Municipal Act, the municipality shall prepare annual financial statements in accordance with generally accepted accounting principles. So what makes up the consolidated financial report? It reflects our assets, liabilities, revenues, and expenses, including 14 fully consolidated boards and commissions, 3 proportionally consolidated entities, and 3 government business enterprises. Note 1 in the financial statements breaks down what those 14, 3, and 3 comprise of. Of interest to the Audit Committee, we had a new board come online, and their financial statements are part of the consolidated report, which is the Argyle Business Improvement Association Management. And of note, this will be the last time you will be seeing the Public Utilities Commission financial statements as they were wound down in 2018. So there are 4 statements at present that make up our consolidated statements. The statement of financial position, which outlines the city's assets and liabilities. Statement of operations that summarizes our accounts by revenues, expenses, surplus for the year, along with the accumulated surplus. Then we have the statement of changes in net financial assets, which looks at our financial assets and what the impact is on our financial assets as a result of annual operations and tangible capital asset transactions. And finally, a statement of cash flows, which summarizes our cash position and how accounts in the statement of financial position and the statement of operations intertwine with that statement. The broad arrow below shows that all these statements are interconnected, and it's important that when there's a change in one statement, it ripples through the other statements as well. So I want to first kick off with explaining some of the significant changes that occurred through our statement of financial position. The city has improved its net financial asset position by $394 million. Is an improvement of $121.5 million from 2017, which indicates from a finance perspective, it strengthens our future liquidity to pay our liabilities and our future expenses. Our overall financial assets have increased by $141.9 million. A good component of that relates to cash and cash equivalents as outlined in note 2, and that increased $89.5 million of that $141.9. Another item that would be of interest is that our investments in government business enterprises and partnerships have also increased by $8.4 million, largely attributable to our share in London Hydro. On the liability side, our liabilities also increased before you at $20.4 million. Deferred revenues increased by $2.8 million. Deferred revenues is largely made up of obligatory reserve funds. The increase in 2018, though, was a result of a grant that we received from the Ontario Municipal Cycling and Commuter Grant, $3.3 million. We took receipt of that money in 2018, but we will not be recognizing it until 2019 as work is being done on the north branch of the Thames Valley Parkway. Employee benefits payable has increased by $4.7 million in 2018. It should be noted that every 3 years, the city brings in Mercers to do an actuarial study to identify what our future payables will be. 2018, we brought them in to update our numbers, so those numbers are fairly current. And then in our accounts payable and our accrued liabilities, they've increased by $5.4 million. One thing to note, there will be a correction made to the financial statements before you and to our 2018 year-end position. It was identified through further analysis and audit that there was $7.3 million of urban works assets were recognized too soon. They weren't fully complete. So this would result in a correction to our urban works payable, reducing that payable by $7.3 million. On the financial asset side, that would increase that $394 million amount back up to approximately $401 million as a result of that correction. Moving along to the non-financial asset component, which is largely made up of our tangible capital assets as outlined in note 14. Our net book value of our assets increased by $150.3 million. However, as a result of this correction on the urban works assets, that will be decreased to approximately $143 million. Regardless of what happened with the urban works assets, recognizing that the asset is being offset with the liability, it does not change our accumulated surplus position. So we still have an increase over 2017 by $272.4 million. And that accumulated surplus includes the balances of the city's consolidated reserves and reserve funds. And once again, that indicates our government's ability to provide future services. To kind of give you a snapshot of what we have as a book value of our tangible capital assets, it is comprised of items such as land, buildings, machinery and equipment, water infrastructure, wastewater infrastructure, road infrastructure, and assets that are under construction. Right now, our net book value is $3.9 billion. Later in the year, administration will be providing to the Strategic Priorities and Policy Committee an update to our asset management plan, which will then indicate to Council and Committee the replacement value of these assets. Some notable assets that we recognized in 2018 and capitalized would be the Greenway Pollution Control Plant expansion. We capitalized $42 million of that work. The Southwest Community Center, Bostwick, $34.3 million, recognizing that the land component was recognized in prior years, so it's a little bit higher when you take into consideration land. Dundas Place, $9.4 million. Phase 1 was recognized as part of our assets in 2018, as well as the Blackfriars Bridge rehabilitation at $8.8 million. Of interesting note, one of the big increases in our revenues were developer contributions of $73.3 million. Those are requirements set out in development agreements between the city and the developer. So what does $73.3 million mean? 13.5 kilometers of roadways were assumed, 17.9 kilometers of sidewalk were assumed in 2018, 23 kilometers of water pipe, 10.3 kilometers of sanitary sewer pipes, and 10.5 kilometers of storm sewer pipes. Flipping over to the statement of operation and expenses, the city's overall expenses increased by $66.5 million or 6.1%. The largest expenditure increases over the prior years were found in transportation services of $27 million, social and family services $20.3 million. Big contributor to that was in childcare. And the next big item was environmental services of $4.7 million for water and wastewater. The $4.7 million increase was predominantly increased due to the write-off of Springbank Dam. Back in 2018, council made a decision as to what they were going to do and move forward, and how were they going to move forward with the asset that we were creating in over the years. And based on the outcome, it was determined that we needed to write off a good chunk of that asset. Key items that are different in our statement of operations from what we do when we go through budget are amortization is recorded as an expense on the statement of operations. Debt principal payments are not expensed, and contributions to capital and reserve funds are also not expensed. With respect to revenues, the city's revenues increased 13.8% over 2017. $33.6 million increase was attributable to tax revenues and user charges. Government transfers increased by $49.7 million. And as we had seen on the previous side with expenses, those transfers related to childcare, water and wastewater, and transportation. Development charges recognized increased by $36.3 million. And developer contributions to tangible capital assets, as mentioned earlier, increased by $36.5 million over 2017. So one of the big questions that I ask myself, and I know members of council ask themselves when they get to the financial statements, coming fresh off the heels of budget and trying to acquaint themselves with budget, is how does the city budget compare to what is before you in terms of PSAB accounting? So in the tables before you, we'll kind of look at what are the pluses and minuses between the two. On the revenue side, we will note that transfers from capital and reserve funds that we identify as revenue on our city budget is not taken into consideration under PSAB accounting. We do, however, identify capital funding earned, developer contributions, reserve fund deferred revenues earned, government business enterprise adjustments, and the boards and commissions surplus. There is some different categorizations when you look at the net municipal taxation. You'll note that on the city budget, we show a number of $599 million. That includes the tax levy and supplementary taxes. However, on PSAB accounting, we also include items such as our grants in lieu, followed by some of the taxation that we do on behalf of our BIAs. On the expenditure side, as alluded to in the previous slide, the city budget will take into consideration from a cash basis the debt principal repayments, transfers to reserves and reserve funds, and capital expenditures such as capital levy, pay-as-you-go financing. Those items from a PSAB, statement of operations basis, is not included. However, we do include on a PSAB basis capital expenses not capitalized, amortization, loss on disposable capital assets, and landfill contaminated sites and employee future benefits liability. So back in April 2019, Corporate Services Committee would have received our 2018 fourth quarter operating budget status report, where we identified that the property tax supported budget had a surplus of $6 million, the water rate supported budget broke even, and the wastewater and treatment rate supported budget had a surplus of $3.2 million, for a cumulative surplus, operating budget surplus of $9.2 million. Through transfers to reserves and reserve funds and reductions in authorized but unissued debt in accordance with council policy, as well as other directions from council at the time, we ended up with an operating fund surplus from the 2018 approved budget of zero, break even. To make the adjustments for PSAB, we look at adding transfers to capital and reserve funds, add the debt principal repayments, add the capital program funding earned in the year. We reduce capital expenses not capitalized, reduce amortization of tangible capital assets. We add in developer contributions to assumed tangible capital assets. We take away loss on disposal of tangible capital assets. We add back reserve and reserve funds, that's a revenue earned in the year. We look at government and business enterprise adjustments, and we reduce any changes in our landfill liability, contaminated site liability, and our employee liability. And then we add in the surpluses from our boards and commissions to arrive at the $272.4 million that is identified in the financial statements. There are some edits to the draft financial report that will be acted on before final publication and before final approval and sign off by KPMG. Administration will be correcting that adjustment to the urban works payable, which will have a ripple effect through the statement of financial position, statement of net financial assets, statement of cash flows, as well as making the adjustments necessary on note 14 for tangible capital assets. There will be also some minor corrections in notes 18 related to a typo in fleet, along with some allocations for sewer infrastructure, sanitary, and storm. I mentioned a couple of times some of the differences between our budget and our financial statements. The big item is that for financial statement reporting, we're governed by the Public Sector Accounting Board, and we need to adhere to public sector accounting standards. And those standards continue to develop and change, improving transparency, recognition, and disclosure. It is a continuum. We are continually make modifications and changes as a result of changes to standards. There have been some previous standards that were fairly significant, mainly the tangible capital assets standard that came in back in 2008, 2009, which led to Note 14, as well as the liability for contaminated sites, which is identified in Note 23. We have tackled that, and we have, I would say, successfully implemented that. Recently, for this year, we had the related party disclosures, as well as inter-entity transactions. However, we do have some exciting times before us with respect to the asset retirement obligations, restructuring transactions, financial instruments, financial statement presentation, and portfolio investments. One of the outcomes from these new standards will be that we will be having another statement added to the fore, which would be statement of remeasurement of gains and losses. So in preparation and in planning for some of these changes coming down our ways, mainly the forefront for me is the asset retirement obligation, is kind of road mapping and planning how administration is going to look at addressing it, and leveraging some insight provided by Deloitte, as well as some conversations that we've had with KPMG. We're looking at a project that will look at addressing the standard by looking at technical accounting, looking at data and systems development, process and closeout reports, readiness and training, and program management. And based on some preliminary timelines that I've seen, this will be about a 2-year project that we'll have to look at and incorporate a lot of operational areas for their information. Internal controls. KPMG has identified that there are areas where we need to continue to strengthen. There is further work required to build and educate on existing processes and awareness throughout the corporation. And there are opportunities to leverage existing city initiatives to increase education, communication, and coordination. And with that, I'd like to turn it over to our audit lead engagement partner, Katie Denbach, to go over our audit findings report.
Thank you, Mr. Collins. I would say explaining the difference between the budget as it gets presented to council and the PSAB version of the financial statements is no mean feat, and you do that very well. Ms. Denbach, go ahead.
Perfect, thank you very much. So what we've got up on the screen here is our audit findings report. I have with me here today Deanna Baldwin, audit manager, as well as Emily Van Dale, who was our audit senior, and sending her regrets is Melissa Redden. She is in Vegas at the moment, so an unfortunately timed vacation. So what we'd like to do is just walk you through the highlights of our audit findings report, and as always, we're happy to answer any questions as we go through. So I'm going to begin on page 1, which is the page numbers at the bottom right-hand corner, which is our executive summary. Just a couple of things I wanted to point out to the committee. First and foremost, just a reminder, the purpose of this audit findings report is to build on the audit plan that we presented to the committee back in February, but also to assist you in discharging your role over financial oversight, over financial reporting, and the financial statement audit. So this is our primary means of communicating with you anything that we think you should be aware of that came as a result of our audit. There were no significant changes to the planned procedures or to our audit from the plan that was previously presented to the committee. In terms of finalizing the audit, we have substantially completed our field work. There are a few outstanding items remaining. The list that is in your findings report here is as of June 7th, so we've knocked quite a few of these things off the list since that date already. But what remains is just a few pieces of our testing, including manager and partner review over those few remaining pieces, as well as sending legal updates. So we obtain updates to within 5 days of council approval of the financial statements. So that is yet to come, as well as completing our conversations with you here today, obtaining evidence that council has approved the financial statements, and obtaining our signed management representation letter. All of those things, once they have been completed, will allow us to issue a clean auditor's opinion on the 2018 consolidated financial statements. There's nothing that I want to touch on pages 2 and 3 of the executive summary, because Deanna is going to go into a bit more detail on those pages, and so I will turn it over to her from here.
Perfect, thank you. So we'll go into the audit risks and results section of our audit findings report. So this by no means represents a comprehensive list of all of the procedures that we performed, but just those procedures that we performed over certain areas that we identified as higher risk. So some key areas of focus, whether there is some management judgment involved or a high dollar value associated with these items. We just want to bring to your attention the procedures that we have performed. And I won't go into our procedures in too much detail because, as Katie mentioned, there haven't been any significant changes from our audit planning report, and those procedures were, for the most part, very clearly detailed in the audit plan. But of course, if you have any questions, we can go over them in more detail. So the first, excuse me, significant financial reporting risk is completeness of accruals, primarily because of the amount of management judgment that's involved in determining the year-end accruals. So our procedures that we performed are the same as those that were outlined in the audit plan, and we don't have any issues to report to you today. The next item here is fraud risk from management override of controls. So this is a presumed risk in every single audit that we perform, nothing that's particular to the City of London. However, because this is a presumed risk, our audit methodology incorporates procedures such as review of significant unusual transactions, retrospective review of estimates, and procedures over journal entries to cover us off here for this risk. And we don't have any significant issues to report to you there. The next item that I want to bring to your attention is capital projects and acquisitions, mainly because of the large dollar value of these items and also the judgment that's involved in determining the appropriate amortization policies surrounding these items. So our procedures are the same as those that were presented in the audit plan, and we don't have any significant issues to report to you. The next item here is payroll and employee future benefits, which is a quantitatively significant balance to the financial statements. And as Ian mentioned, this was a full valuation year. So as part of our procedures, KPMG reviewed the assumptions that Mercer used to develop their report, and we don't have any issues to report. The next item is taxation user charges and transfer payments revenue, which is a qualitatively significant balance. We did identify a difference as a result of our procedures performed here with respect to grant revenue that should have been deferred at year end, but had been recognized in the statement of operations. So as a result of the difference that we identified, we expanded our testing and we didn't find any further differences. And that difference that we did identify has been corrected and is summarized in the management representation letter. The next item here is an update of standard cost estimates for assumed assets. So during the year, the city engaged CD Waters to perform an update of the standard cost listing that's used to value assumed assets. This represents a significant balance. Assumed assets represents a significant balance to the City of London. There was 73.3 million recorded in assumed assets during the year. So what we did was we reviewed CD Waters' process for determining the value of those assets, and we did perform some testing over their assumptions, and we don't have any issues to report to you there. And the next page here is just some other audit matters. And some of these Ian touched on in his report, but I'll just highlight some of the more significant ones for you. So during the year, the Southwest Community Center was fully completed, and that asset is now being amortized, and that amortization expense is being taken into the statement of operations. And as Ian mentioned, there was also a write-down on the Springbank Dam during the year, just as a result of being able to determine what the value of the future use of that dam is, and then being able to quantify what that write-down should have been in the year, or was in the year. And again, as Ian mentioned, you've done my job for me here. During the year, the PUC transfer, or the Public Utility Corporation or Commission, transferred all of its assets and liabilities to the City of London. So on a go-forward basis, you won't be seeing standalone statements for the PUC. The municipal accommodation tax is a new revenue stream that the city realized during the year. The corporation reported gross revenues of 0.9 million in fiscal 28, which was their share of the revenue corrected as a result of this new stream. Turning over to page 11, just a summary of our significant accounting estimates. So again, estimates require significant judgment, and therefore we want to highlight to you that this could potentially be an area of higher risk within the financial statements. So we want to draw your attention to the procedures that we've performed here. The first one being landfill closure and post-closure liability. Oh, thank you. Which is a liability of 39.2 million at year end. Determination of this liability is dependent on significant management estimates, including expected and remaining capacity of the landfill, expected closing costs, and estimated time needed for post-closure care. So we believe that management's process for developing this estimate is reasonable, and we don't have any issues to report to you there. The next significant estimate here is accounts payable and accrued liabilities, which again is quantitatively significant to the financial statements, with a balance at year end of 170.4 million. Again, we believe that management's process is appropriate in developing this estimate, and we don't have any issues to report. We also wanted to highlight for you, over the last couple of years, we've discussed the use of data and analytics within the audit. So we wanted to highlight some of the procedures that we've performed using data and analytics in order to give us a better understanding of some of the relationships within the financial statements. So the first one is journal entry testing. So we use data and analytics to apply certain criteria, which would help us to identify those items that maybe those journal entries that didn't fall within our expectation, and then we selected those items for further testing. The next application of data and analytics is with respect to WIP. So our expectation is that projects that are in WIP would continue to incur costs. So we looked at those projects that were in WIP at December 31st, 2017, and did further analysis for instances that we identified where there weren't any costs incurred in 2018 to see if that was appropriate. The next item is that we perform data and analytics over disposals. So our expectation being that disposed assets should not also be in the tangible capital assets listing at year end. So we performed a comparison to ensure that all items that were disposed during the year were not present in the TCA listing at December 31st. And then the last one we wanted to bring to your attention is with respect to holdback accruals. So our expectation being that all projects in WIP should have a holdback accrual recorded. So we used data and analytics to review to make sure that that accrual was complete, and reviewed any items where we did identify any differences or deviations from our expectation. And with respect to all of those procedures there, we don't have anything to report to you today. And then again, Ian's done a great job of summarizing the future accounting pronouncements that are going to be coming into place. The main one being asset retirement obligations, which will be applicable for the year ended December 31st, 2022. And we're in regular communication with management to discuss what the implementation process is going to look like and how we can be of assistance.
With respect to adjustments and differences, there are no uncorrected misstatements that were identified and not corrected in the financial statements. There were 2 corrected misstatements, and you will have seen distributed an updated management representation letter. At the back of that letter, it outlines those misstatements. Ian has spoken to both of them already, one of them with respect to deferred revenue, and the other one with respect to the urban works payable. And so those have both been corrected and reflected in the financial statements. In terms of control observations, we are required to report back to the committee any significant deficiencies in internal control that we identify as part of our audit. We have not noted any significant deficiencies in internal control, but we do have some other control observations that we wanted to bring to your attention. The first, basically every time we have an audit misstatement, we step back and say, okay, what caused this and how could it possibly be prevented on a go-forward basis? So the first is just management review of grant contracts. So this is with respect to the deferred revenue adjustment. So there was one instance where something was not deferred and it should have been. So we're just recommending that a process be put in place to have those agreements reviewed so that this would be caught in the future. The second item here, if you were on this committee last year, you will have seen something very similar. So it's a carry forward from prior years with respect to payroll agency 3 and the timeliness of taking terminations off the payroll. We had noted in previous years some instances where people were receiving nominal amounts of vacation pay that they weren't entitled to. So our understanding is that a process is being put in place to address this and prevent this from happening in the future, but I think it is still in the works at this point. We did not identify any further instances of this during our testing. And then one of the other items we noted is with respect to review over what's called general accounting journal entries in TCA. So these are posted by someone in the TCA group and then prepared by someone in the TCA group and then entered by someone in finance. And our request there, our recommendation is just that someone within the TCA group who has the detailed knowledge of what's gone on with that journal entry should be reviewing that journal entry before it gets posted by finance. Moving on to a couple of other observations that we noted during the course of our audit. During our testing over payroll, this one's really just a process improvement. We noted some adjustments needing to be made to time cards, and it really resulted from areas where managers were entering time on behalf of their staff and maybe not knowing if there was a day that someone left early or the hours were being adjusted after the fact. So just a recommendation there, where possible, to update the process so that after the fact adjustment isn't necessary. And then the last one is with respect to IT login security. We did note some instances where passwords were pre-populated into the JD Edwards system, and so our recommendation is to disallow that, basically, so that somebody, if you're not at your workstation, so that somebody can't go in and pretend they're you and have your access rights, which they may not be entitled to. So that is another recommendation we put forward. And then that brings us into the appendices. One of the reasons why I'm thankful we have a screen here, because I'm sure you can't see the color in the package that you received. During our audit plan, we mentioned some technology tools that were available to us. One of them is Tableau, which assists with visualization. So one of the things we did as part of our audit was, and it's more for discussion and information to the audit committee, was to take a look and say, of the tangible capital assets that are currently here, when will they be fully amortized? And the idea behind this is really that their estimated useful lives for accounting purposes should more or less reflect. I'm sure it won't be an exact science, but when they might need to be replaced. And so that's what the next 2 pages provide to you, is just some information by asset category. To say over the next 50 years, how are your assets, when are they going to be fully amortized? And so that will show you, a general indicator as to what types of capital expenditures might be required in the future. And then the next page to this just breaks down that 0 to 5 year category. And so you can see, for example, in 2020, there's quite a large amount of machinery, equipment, and furniture that will be fully amortized. So might want to keep an eye to whether this amount really does need to be replaced in 2020. And again, the caveat is this is based on, your existing assets that are in place. Appendix 2 just detailed some required communications that we have with the audit committee. So including our auditor's report, which is attached to the draft financial statements, our independence letter, which is attached here, as well as our management representation letter. And as I mentioned, there has been an update to that for that last adjustment. So that's the paper copy that you received. Appendix, so I don't need to speak to these. Appendix 5, I just wanted to bring to your attention. It is a current development, but one that is still in sort of a give us your thoughts period from the Public Sector Accounting Board. So it's not going forward at this point, but they're asking for input. And so basically, anytime there's shared pension plans, so they're looking at how those get accounted for. Currently, the institutions that are involved in the pension plans don't record their portion of that liability on their statements of financial position. So there's discussion around potentially requiring that in the future. KPMG has provided a response to the Public Sector Accounting Board expressing concerns about that and all of the potential volatility and difficulty that might come as a result of that, but just wanted to make you aware of that if you weren't already aware of it. And the last appendix here is some information for you on cybersecurity. One of the things we also did was we requested that management fill out just a high-level cybersecurity questionnaire, really just for information for the committee to help you identify whether you feel there might be any gaps or red flags in cybersecurity as it relates to the financial reporting process. So the questionnaire that's included in our report was completed by Matt Daly, the Director of IT Services, and it's there for your information and discussion. And with that, I'm happy to turn it over for any questions you may have.
Thank you very much, Ms. Denbach and your team. Colleagues, I'd just look to see if questions for KPMG or perhaps for our staff about either of those presentations and the material that's in front of us. Councillor Turner.
Thank you, Mr. Chair. Just a couple of quick ones. Identified in both reports there, identified the payroll liabilities associated with the WSIB and vacation and sick time and things like that. From the report, it shows that WSIB is estimated actuarially, through actuary science to try and figure out what liabilities we might incur in a given year, I think is, and then expensed as budgeted and then paid for as current expenses. WSIB probably wouldn't carry from term to term, but those sick leaves or the sick time and the vacation time, I think we have an older set of staff that might be under former CA rules that allow them to carry it over from year to year. As you incur it, I'd imagine as you accrue the sick time or accrue the vacation time and you don't use it and it carries over, we would likely put the money aside into a reserve or something like that to pay it out when that was incurred. The difference between the two, though, is that the salary might go up or just the general cost of that liability might increase over time because it wasn't realized in the year that it was accrued. How do we finance that gap? Do we do that as an in-year operational cost? Do we try to take an investment lift from the money set aside, or is it a liability in the current year? If that made any sense.
I believe just before you answer, before you got here, Councillor Turner, I did suggest that when we get into the questions, that we start with the page reference. Just so you know, so that everyone can find what the page they're looking at before you start asking the question. That's just a tip for your next question. Go ahead.
Thank you. Through the chair. So one of the things that the city does through its reserve funds is we know that we have a future liability with respect to employee benefits payable. So that liability is updated and we know what that is in real dollars. And what we do is we have a reserve fund that, and through the the end of the year report, there was a contribution made that puts toward our reserve fund that is saving towards that. So So on the city side, essentially, we have approximately, right now, the target for our reserve fund is about 127, or sorry, where am I? I've lost the wrong one. Is that, yeah, is totally, is 100. So we're nowhere near what that amount is, but we do, through our personnel savings, try to save for that each and every year through the personnel savings. And that is the contribution that we specifically put forward in our, we anticipate what that's going to be at our mid-year monitoring. And then at the end of year, based on our final surplus that we report, whatever based on that proportion of personnel savings, we set that aside. So we did make a significant contribution at the end of 2018 that certainly helped us reach towards that goal, but we're not funded, and we still have a ways to go. But that is certainly part of the plan, that as our personnel savings materialize, we are putting those aside for the future to help close that gap for the future liability when that payout does need to occur.
Just to clarify, in terms of estimating the actual liability, you're using the current wage rates, at like every time people's salaries are increasing, you're using the most recent ones to do the estimate, okay.
Thank you. Page 57, by the way. That's helpful. So is there conceivably a risk, I guess it might be theoretical, that the cash flow balance could delve into negative on that, or it sounds like we're generally satisfied that those mechanisms and procedures insulate us from getting into a negative balance situation in that circumstance.
Through the chair, so I think one of the risk we believe is low in a given year, that all the liability would need to be repaid at once. But certainly, I think as we see a lot of retirements come in the future, there may be a greater proportion paid out over a current year than what we might have historically seen in the past. So I think given the targets that we've set, I mean, I don't think we would ever want to close the gap entirely and have it fully funded, because I don't think you'll ever come to a point where you need to do that. But that's some of the work that we're doing now, is to look at a specific percentage to say, once we've hit this specific target, we know we're not going to put any more in there. So we're quite a ways away from that at this point, but based on the contribution that was made this year, we're satisfied that that risk is quite small.
Thank you. I will reference a page, but I mean, these are really philosophical questions. They're operation rather than specifics on the numbers. On page 20 of the KPMG audit findings report, it has that nice colored graph of the TCA amortization timeline over 50 years. With respect to our practices on determining amortization period, obviously there's a spread that's allowed through PSAP rules. How do we choose on an asset-to-asset basis what the amortization schedule is? And then further to that, what happens in a circumstance where the amortization period that we assign to that asset has not fully elapsed and we have to replace that asset before the amortization period has completed?
Through the chair to the councillor's question, back in 2008, 2009, we looked at the various groupings of assets and came up with a general guideline for when an asset comes on board to apply an amortization lifespan for it. So we depreciate all our assets within a given categorization consistently throughout. And there will be times where in actuality, an asset will live longer than the amortization period. From a financial reporting standpoint, that will have a low, if minimal value. But there are times where an asset's life operationally ceases to exist before the amortization, and that's where we'll have like a loss on it, and we will report that out. But we do take into consideration the lifespan of assets, and you will note that through the budget process when it comes to fleet and when they review their fleet life cycles, they're continually reviewing that to ensure that they have the right amount of money set aside for when an asset comes up for replacement. That's why later on in this year with the asset management plan, that replacement value of our assets will be fairly critical to know what that cost will be to ensure that we have enough money set aside to replace those assets when they come up. Make no mistake, the net book value of an asset does not reflect what the cost will be to replace that asset. So we're very mindful of that, and we're increasing increasing our asset management practices to ensure that we can continue providing the same level of service that our community has grown to enjoy over the years.
And last really quick follow-up, thank you. So it sounds like we've got a fairly good process of identifying it, that we've been fairly accurate in identifying the TCA life in terms of its amortization. I'd imagine that's probably a lot easier to do with something like fleet, where you might be running vehicles on 4 or 5 year cycles, but a bridge or where you're looking at 50-year might be a much more difficult thing to land on. But in general, we're pretty comfortable with the assignment of amortization periods.
Yes.
Other colleagues, go ahead.
Through the chair, question for KPMG, and it's on page 64 of the binder relating to the investments. And so in your audit results package, you did highlight some areas that have significant quantitative balances, and I would see the investment balances here also as being very significant to the financial statements. And wondering if you can describe your audit procedures over this $564 million of assets in general, but also a little more specifically on asset-backed securities, because I know they sometimes have different methods of assessing market value.
Thank you, Laurie. Through you, Mr. Chair. You're correct. The investment balance is a significant balance quantitatively to the financial statements. So the assets, the investments are not recorded at fair market value, as you would see in some other public sector entities, because the city has not yet been required to adopt financial instruments. What we do to test the investment balances, we confirm them with the investment managers and the investment custodians, and we also do substantive testing over significant transactions that take place. So we confirm unit values and we confirm costs of the investments, and it's quite a large section of our audit file, to be honest.
Thank you. And one other question, if I may, relating to the internal controls observations, thank you for bringing those forward, including your recommendations. My question on this is, what is the process for management to respond to these? I saw the team nodding, I think, in agreement with the observations and the recommendations, and think it would be helpful for the audit committee to have a sense of, are all of these being pursued for follow-up, or are some of them perhaps lesser priority, and we'll just accept the recommendation and move forward?
Through Chair to committee, with respect to some of the observations that have continued from previous reviews with respect to payroll, we're continually watching and putting in practices to put in the necessary controls to mitigate those. There have been conversations with the various areas on their practices, so we will continue to improve those practices with respect to Agency 3. With respect to the observation made on IT login, we've already reached out to our ITS team and looking at ways to put in protocols to limit people leveraging web browser capabilities to auto-populate a lot of our web-based applications, as mentioned by KPMG. With respect to the observations for TCA, it comes down to an increased awareness and education to the various areas for some of these controls. Like other areas within the corporation, there's a lot of there's some turnover as well as movement within the operations, so that gives us the opportunity to revisit our processes and practices and making sure that our SOPs, our standard operating procedures, are in place and make people more aware. It comes down to communication, awareness, and education. So a lot of the items that we've acted on with respect to the recognition of grant revenue, as KPMG pointed out, part of the curveball thrown with that example was communication between the two service areas. We will be working with our business administration areas to make sure that when a government grant comes in, that they're aware of the recognition principles from the accounting standards to make sure that we're not recognizing that revenue until we start incurring those expenditures.
Any other questions, colleagues? Councillor Reynolds.
Thank you very much. Maybe I'll start with the KPMG report, page 13. Talks about the I don't know if I get, or maybe that's the, I'm sorry, I wrote down page 13, but it was data analytics, so maybe page, oh, it is page 13, okay. Or page 16 or page 13, depending on how you look at that. But data and analytics, I just wanted to ask you a little bit about the journal entry testing. And so what makes a potentially high-risk journal entry? What, as you search through all those things, what kinds of things are pulled out and looked at?
Through you, Mr. Chair. That's a great question, and it's different from entity to entity that we audit. For the city, the types of things we would look for would be anything significant in dollar value. We can also look at, depending on the data that we get, things that are posted on the weekend or, you know, where you wouldn't expect to see journal entries posted. Journal entries posted by specific users, for example, people that you wouldn't expect to see posting journal entries, and that's how we obtain our sample of journal entries to dig into further as they represent sort of the higher risk type entries.
Okay, thank you. I'll switch to a question that was related to Councillor Turner's inquiries. The asset management. We had recently won the Greenway reheater. It was a piece of equipment that only lasted 2 years. We're going to replace it. We're pulling it out and putting in a new one, but we're also going to try and rehabilitate the one that was there. In this kind of instance, does that become a new item? Or is its life cycle? Do we write it down when we pull it out, and then the potential refurbishment becomes a new item, or do we try and refurbish it and then connect those two as the same item?
Depends on the degree of modification that we would either write it down completely and then recognize it again as a completely new asset, or if it is somewhat salvageable. For example, the Springbank Dam, we did keep a component of the Springbank Dam. We didn't write it 100% down. There was still the foundation that we kept up because we recognized that it could be repurposed for something. So we didn't write that 100% down, but we wrote down most of the machinery and the equipment that we recognized that we would not get any additional useful life. So depending on the degree of modifications that asset would entail, would dictate whether or not we're going to write it completely off and then bring it back as a completely new asset and then start the practice of amortizing it over that remaining life, or that we just add on to whatever's still usable on that. The big thing is it going to extend its lifespan as well as provide for service down the road? So we'll have to examine that on a case-by-case basis for that asset.
All right, thank you. Perhaps I'd go through the chair to the city manager, ask a question regarding the project management strategy. Could you give us a vision of what that's going to be like? There was some, good deal of reference to that in the KPMG report, and I guess I'm looking for a vision of what's our project management strategy going to be like, and see how it might be being developed.
Through the chair, well, with respect to project management, there are a number of areas that are good at it, and there are a number of areas in the corporation that are not so good at it. And so bringing consistency across the corporation is going to be an important part and part of the focus, probably of my office in terms of putting together some standards. We certainly have a good head start with a lean program and the resources that we have available in that particular area to help us. There are also a number of other resources across the corporation that we can pull together to help develop the standards and apply that across for all project management. Then the other side of it is that when we get into projects, obviously you need to have the right resources dedicated to delivering on those projects. And some areas are more geared to projects than others. But specifically, if we start talking about IT projects, you're drawing from resources all over the corporation to deal with them, from an end user perspective at least, and from a testing perspective, and that's a really big area. That's one we recognized many years ago, And we tried to establish a team to do that, especially in the finance area. And Ms. Barbon can speak to that, or I can, because I set it up. So, but again, it's really getting the standards and driving them through the corporation, and then making sure we got the resources to support those projects as we move out.
Thank you. And although it was addressed by Mr. Collins, the graph that really interested me was in the, what section? It was the one in the financing, how the financing sources changed over from 2014 to 2018. I don't really see a page number on this one, but what we noticed was that the percentage of municipal taxation went down, grants were about the same, the user fee is about the same, but there was a number of others in there, and I think that was DC charges. And how can I describe it? This is counting backward from the 5-year review tab, 1, 2, 3, 4, 5 pages. Financing sources for municipal operations. So that was very interesting to me. We had a lot. The other had quite a bit more, and I think you said that was from DC charges, and I think maybe the municipal accommodation tax might have been part of that. But can we talk a little more about that and how we can make those others even more a part of our city revenues?
Through the chair to committee, as indicated in the presentation, that figure 8, 5-year overview of financing services or sources, really indicates the proportion to which our various revenue sources comprise the amount of money that we take in. It was very interesting to note that proportionately the tax side has dipped a bit, and when I'm saying it's come down, it's about 1 or 2 percentages, but that has been made up by other contributions. I think a big portion of that was the amount of contributable tangible capital assets that came from developers, coupled with some increased transfer payments that we received from other levels of government, which predominantly went into like childcare and transportation. That was identified on the statement of operations on the expenses and the revenues. So we do have funding sources coming in through the Clean Water, Wastewater Fund and PTIF. So there are one-time blips that come in, and I believe last year at Audit Committee, there was concern about the amount of government grants that the City of Ottawa was taking in. It was so disproportionate to other municipalities. We're noticing that grants tend to be one-time in nature, so we'll be monitoring it in 2019. Potentially, those could shift when we look at 2019, but I just thought it was an interesting point to mention in the context of a 5-year trend that proportion kind of shifted. So it was something to make note of, and obviously you picked up on that too when you were reviewing the document.
Okay, so thank you. So this is maybe more of a one-time thing then, okay. And did I might have had some questions on the financial statements. On page 46, we had we had some investment income, and I just noticed that the budget was much less than the actual. So I'm looking at a budget of 3 million, but in the actual for 2018 was 18 million. So I'm wondering what surprised us there?
Through Charge Committee, often when we budget for investment income, we base it on the available cash balances, which would be attributable to the amount of money that we have in our reserve funds. often the amount of money that we have in our reserve funds would be committed to a capital project, and we may be planning that a capital project will draw down that reserve fund in that year. But in the event that there's a delay or we don't draw down that money is earning interest. So a year or 2 years ago, we may have planned that we'd be drawing down to pay for this capital project, but that capital project has not incurred any expenditures yet, so we still retain that cash, so we'll start earning some interest on that balance in the reserve funds.
Okay, and I also see that we had maybe 150% of the development charges earned in 2018, so that's a bit of a windfall. Could you make a comment on that one?
Once again, based on what was drawn down from the reserve funds, that's when we recognize that revenue. So just yesterday at Corporate Services Committee, Council would have received the 2018 City Services Urban Works Reserve Fund status report. And in that report, it was identified that there was additional expenditures or increased works that were just done through City Services and Urban Works with a noted corresponding drawdown from that reserve fund. So when we take that money in from that reserve fund, we then recognize that as revenue. So that was related to works paid out through City Services and Urban Works.
Okay, thank you. I'm happy to turn this over to my colleagues.
Any other questions about the financial statements? Councillor Morgan.
Yes, I just have one question, although it's a two-parter, so that's tricky. It refers to no pages whatsoever. Did you receive the full cooperation from our management team? And is there anything that was not in your written or verbal presentation that you think we should know?
Through you, Mr. Chair, to part one, yes, we absolutely received the full cooperation. Thank you for giving me the opportunity to thank Annalisa and Ian and Sharon and their team, because we are on site for 2.5 months, and we require a lot of their time and support to get through this in answering questions and providing documents. And so we certainly appreciate the support that we get. So yes, absolutely, we had no troubles getting the information that we required to be comfortable and to get the audit support we needed. And to respond to the second part of your question, no, we have, hopefully you can tell by the length of the report we provided, we have put in there anything that we thought may be of importance or of interest to this committee.
Yes, and I'll just note that I asked that more as a due diligence question than as a commentary in any sort of way on our management or your work at all. So I appreciate the answer.
Any other questions, colleagues? Go ahead, Ms. Hickson.
Just an observation, given this is my first time participating on this committee, I didn't realize that a binder with 476 pages would be delivered to my front doorstep. But I have to say, as I read through it, as well as KPMG's report, I was left really with an overall reflection of our city is in good hands with the finance team. I think we have a very well-managed operation here, and that really came through. So thank you for all of your work and the binder, and to our auditors also for spending 2.5 months auditing this. I think the report that KPMG provided is also a testament to management's competence in terms of really no significant findings, just all factual account of what happened. So I was really pleased to see the report. That's all.
Okay, I don't see any other questions. So I did have one from the chair. It's about the same page it was asked about earlier, 57, the employee benefits payable. I'm going to give a little bit of context because I think it might be necessary before I ask the question. So last year, there was an interim decision from the Human Rights Tribunal about whether you could terminate benefits at age 65. That has not become anything other than an interim decision, but in terms of calculating the employee future benefits payable, like this liability, how, when you're making these estimates, do you incorporate things like that, where all of a sudden this was specific to health, dental, and life insurance? How do you incorporate a decision like that, which is not a court decision, but a tribunal decision? How does it factor into the estimates you're making around the future benefits that might be payable?
So through the chair, so I think part of this is some of the timing. So I'm not 100% certain off the top of my head if how Mercer's, who does a lot of the work for us, they base it on our collective agreements. They go through a number of things, all of our potential commitments for all of the personnel. So certainly if there is an obligation for employers to continue paying, that would mean that there's a potentially a greater liability down the road. So I think that's certainly something that when they do their refresh, like every 3 years is when we do an update, that it's quite extensive. And then from that, on an annual basis, we just have some interim measures just to roll those forward. So I think one of those things is something we'll be looking. I know that there was some recent further decisions that have still, so I don't know if this is 100% yet final, but it is something that certainly could have some potential with respect to municipalities as a whole, all employers as a whole, in terms of what those liabilities would be. Depending on the I don't know, depending on some of the other ones, just how significant the magnitude will be. I don't think it's as significant as some of the other things, certainly, that we have to from vacation and other perspectives, but it definitely would have an impact. So it is something that would be taken into account, that if there is an obligation there, it would definitely represent part of the liability that would need to be captured. So there would be an impact. I can't tell you specifically what that quantification is, but it is something that would totally have an impact.
I just wanted to also say, and just to reiterate some of what Lori has said, I think especially when you look at the 5-year review, you can see, I actually have a spreadsheet that tracks those numbers going back, I think, about almost 20 years now. You can see the progression from a situation where we had pretty significant debt and pretty high interest costs associated with the debt to a situation, and relatively low reserve funds, to a situation where we have much more in reserve than we do in debt of any kind. We're paying much less in interest payments than we are now. And from a financial sustainability perspective, you can see the fiscal discipline over time, how things are changing in terms of how we're financing capital infrastructure in particular. And when you just look at the financial position of the organization alone, I mean, it's outstanding. It's not like it's just pretty good. It's like really, really good. And that's a result of a lot of great work by our finance staff and all people throughout the organization. Glad to see that the audit had caught a couple things, small issues need to be corrected. I think that's the purpose. I'm glad you picked up on the control issues also. I mean, you're the external auditor, but it's nice to pick up some control issues there. And if there's a motion from colleagues, I think we can deal with that, and then we can move on to even more internal audit related things. Councilor Van Holst, seconded by Lori Higgs. Okay, let's have that up for a vote. As you know, we don't use the screen, so all those in favor? Any opposed? Okay, that's carried. Okay, that brings us to item 4.2, which is the progress memorandum on the class replacement pre-implementation review. I see folks from Deloitte here, Anissa, and then I also see Mr. Stafford in the back there, so we have questions for him. Thanks for coming early and sitting through the whole discussion of the financial statements. Go ahead.
Thank you, through the chair. Today, accompanying me from Deloitte is Aaron Whitcomb. He's a senior consultant that works on the various audits. Jim Price sends his regrets. He's currently out of the country dealing with another client matter. So in terms of the progress memorandum, internal audit has been working with management on completing a pre-implementation review, looking at the class replacement system. In terms of the items that we've been focusing our attention on, it would be looking at the internal control framework, we'd be looking at the workflow design, as well as looking at the requirements around the data migration. The one aspect I'd like you to note is this is a continuous audit, so you'll get progress memorandums throughout the implementation of the project. So this is at a point in time, and it's really to help management look at what are some of the best practices, what are areas for improvement, so by the time the system is implemented, there's no surprises at the end. So just wanted to caveat that as we work through this memorandum. So in terms of what we spent time working with management on, in terms of defining the scope, we've agreed to roles, responsibilities, looking at logistics, timeframes, and milestones throughout the project, looking at what the approach will be around the project charter, how this will be rolled out within the city. Also looking at an understanding of the system of controls, having interviews with various management, as well as reviewing the documentation that is currently in existence, and as well looking at talking through the observations that we've identified. So within this particular review, we've identified one high observation as well as two medium that we'd like to bring your attention to. I think the one key aspect to keep in mind is that the key within this progress memorandum at this point in time is really looking at the formality around documentation and what is available for internal audit to be able to review and assess and to be able to collaborate from the conversations that we're having with management. So when we look at the first observation, the high priority is around the project execution and support. So here we'd be looking at the city has not approved nor implemented a standardized project management methodology for various teams across the city to be able to follow when you're looking at implementing a new system. So management has commented that they will consider this as part of the 2020-2023 multi-year budget and looking at their potential organizational structure. And I know Mr. Hayward did make some additional comments when the question was posed to him earlier. The other observation we have is the medium priority, and it's looking at the operations surrounding Perfect Mind. So what we've observed is that the team has not incorporated into the project plan an assessment of the core business procedures, looking at the balances as well as the reporting. Management has felt that they have addressed the risk in the sense that they have done a fulsome review of the business processes, looking at the documentation based on a prior solution that they had agreed to terminate in 2016. So they do feel that they have addressed that particular item. And the other item to draw your attention to is observation 3, again, a medium priority, and this is around project resourcing. So we've identified that the project team does not have a documented project resourcing schedule that's mapped to an existing project plan. And management recognizes the observation, and they've indicated that they will begin utilizing shared resources, including Outlook calendars and Excel, to start putting a plan in place accordingly. The other observations that we have are more low priority and leading practice for management to consider as they work through the project. Are there any questions?
Any questions on that report? Councilor Van Holst, related to your earlier question.
Yes, thank you. And actually, I'm sorry, that question should have been here. So my apologies. I just had a few more things that I was juggling and got confused there. So, but thank you for that. And I think that's, I think the direction, I'm happy with the direction we're going. So I can leave it at that.
Might be the first time we've had a pre-answer. That's excellent. Any other questions? No? Okay, continue.
Okay, moving on then, the other documentation that we have before you is the internal audit dashboard. So we are making progress in terms of looking at the 2019 internal audit plan. We've spent time with management to start putting down an estimated time frame of when the various reviews will be executed. We thought that'll help provide the committee some clarity and also expectations around when you can have an understanding of when fieldwork will be taking place as well as reports will be delivered. The one update to the dashboard is actually on Monday. We had our preliminary discussion with the city planner around looking at the smart city office. So that scoping of that review is currently underway. What you'll also see is that where we are making progress on the 2017-2018 internal audit plan, we are in the report stage for construction procurement. We need to spend some time with management going over our observations. We are starting the IT security assessment, and our goal is that those two particular projects should be completed by the end of September. And in terms of the class replacement pre-implementation, our understanding, I should have mentioned when I had spoken about that report, is implementation will be around March 2020. So that'll be ongoing until that project wraps up. Are there any questions on the dashboard?
Councilor Reynolds.
Thank you. Just in terms of your percent complete and how you calculate those, now that you've had the talk with the planning office about the smart city, could I change this to 5%? Is that?
I think it's fair you could change it to 5%. We've had the initial discussions to discuss what the preliminary scope could be of the review.
I don't see any more questions. Go ahead.
The other document I would bring your attention to is our observation summary. So this is just the update in terms of how management is progressing in closing the observations and actioning their action plans. So currently this quarter, we've been able to close one of the outstanding past due observations. And you'll see that the timelines around the building permit process assessment, those 3 observations still remain open as management is working with IST accordingly. And for management compensation, the delay on that particular project is due to a new position that needs to be filled. But our discussions with management, we are in agreement that there are plans underway and that progress is being made to close observations accordingly.
Councilor Turner.
Thank you, Mr. Chair. Through you, I just wanted to make a quick comment about how much this report I really appreciate. This was one of my challenges in previous years, is that we got a lot of recommendations that came forward, and we didn't really know how many were actioned, what was the result, the end result of having gone through all of that, and whether there were difficulties in the implementation or completion of the recommendations that came forward from the internal audit. So this is very helpful at a glance, and very helpful to see going forward too.
Just a brief question. The management compensation process assessment, the timeline that's indicated is next month, so everyone's still comfortable that that's when that's happening. It says July 2019.
From our follow-up conversations with management, that was the agreement around the timeline for that. So again, this was as at June 10th. I'll just caveat that, so in case there is any changes, if management would like to address it.
Go ahead.
And the final document, this is just our internal audit summary memo. It's basically a summary of what I've just described to you. So,
Any questions for the internal auditor on really any of those reports if something's come to you? No? Okay. Could we have a motion perhaps to receive all of those reports? Councillor Turner, seconded by Councillor Morgan. All those in favor? None opposed? Okay, that carried. Is there any other business, any deferred matters, additional business? No? Do I have a motion to adjourn? Moved by Councillor Van Holst, seconded by Councillor Turner. All those in favor? Okay, enjoy your summer, everyone. I'm getting married on Friday, and I'm taking off to go to Europe. So hopefully there's no urgent audit committee matters that happen once I leave.